All right. So, financial services sector has done fairly well over the last year and a half or so. A lot of that has to do with COVID and the banks receiving so much money from the federal government. But outside of that, banking hasn't really been affected very much at all from COVID. I mean, the banks are essential. They're still doing business. The markets stayed open. There have been some losses in the equities, right? When some of these companies are investing in, Nike and Hilton and some of these companies that hasn't done so well. Some of the banks have lost a little bit of money there, but their main course of business hasn't been affected much at all. We're currently in Blackstone, and Blackstone was a little bit of a worry because of their heavy real estate investment. But Blackstone has assured shareholders that their their profits and everything haven't really been affected. A lot of their customers are still paying their leases. They're high end, not malls, but high end shopping centers. And they're open, at least in a lot of places, and so they're still paying their leases, and so that means Blackstone is still making money. Blackstone is still the largest alternative asset manager in the country. They are just closing deal after deal after deal. Billions of dollars are flowing into Blackstone in order for them to then turn around and invest that money. And they have a bunch of cash on the books to invest that money. So when I started looking at possibly moving into Bank of America, uh, my my biggest concern was earnings, right? I really wanted to see how profits were affected because of COVID. And so let me show you kind of what that looks like. So this is Bank of America, and you see here net income, okay, fell off quite a bit, and you can kind of see that here in the charts, okay. 2017, 2018, 2019, and then this year of 2020. Like I said, it's fell off quite a bit, but they're not doing poorly, right? The other thing that I'm keeping an eye on is the price to book. Okay, now what price to book means is it's important for a bank, right? Because the book is all of their assets minus their liabilities, which is their loans. Okay, and so when you take the assets minus the loans, that's like how much the company is worth. Okay, and how much the company is worth is directly related to their stock price. Okay, and so if you take the stock price and you divide it by the company's worth, we find that it's the same, right? And so banks always hover around that one. When they get below one, most people in the financial industry will say, well, clearly this is a cheap stock price, and we ought to buy it because a bank stock price should never be lower than their book value. It's just because they're a lot of what they have is cash and stock, so they can always just sell it real quick for cash, right? Um, so that's Bank of America. Now we want to compare that with Blackstone. Let me go ahead and pull up. I believe I have DFS and my HIG. All right, so we'll be able to kind of look at these somewhat side by side. Now, HIG, remember, was on the best performing or in the best performing portfolio 5 of the last 12 months. You see their price to book is slightly below 1. So that's really good. And you see that their earnings, just based on the visual chart here, has done fairly well over the last 3 years. Now, just like everyone else, their net income has fell off just a bit, okay, but not a lot. Um, let's see. Oh, yeah, that's not going to work. Okay. DFS is Discover Credit Card. Okay. Now, Discover is not really a bank. All right. So their price to book is going to be a lot different. But they are a financial services company, so that's why they get lumped into this sector. But as you can see, their net income has dropped by more than half. More than half. I mean, they have not done really well at all. A lot of the reason why is because Discover, I'll keep wanting to say Discover MasterCard, but it's Discover Credit Card is usually like travel, right? A lot of people use Discover cards for travel and restaurants and things like that. So because of COVID, people aren't using Discover as much as they have in the past. And so that's something that I'm looking at, because remember, we're only choosing companies for the next year. July of 2021, we'll be looking at switching these out again, possibly. So the earnings were really important for me. And so we're not going there. And so Blackstone, as you can see, their net income fell off by a lot, okay, a lot. And there's honestly just not a lot that I could say about that, other than, revenue is way down, right? I mean, they're only getting half of what they got over the last year. But they've performed very well. And so this was a real situation for us. Bank of America, again, it fell, but not as much as the other companies, which makes a lot of sense because, Bank of America is a big American bank, and a lot of what they did in 2020 was backed up by the U.S. government. They received a lot of money for those COVID loans. And so the question becomes, do we, again, get out of Blackstone and go into Bank of America? And just want to look really quickly. Do I have it pulled up? I think I do. Yeah. And so what I'm looking at is these are the attributes, okay, for these companies. And so we see Blackstone here, okay. Bank of America is here. This is the 1 month return, okay. This is the 98th percentile. So it means top 2% of companies in the financial services sector for 1 month return. So it means that they're doing really well. And I want to keep in mind, this is over the last 3 years. Okay, so this is not current. This is over the last 3 years. All right, so over the last 3 years, Bank of America has averaged a better return than Blackstone, but not by a whole lot. Okay. Bank of America's beta is better than Blackstone, but again, not by a whole lot. Blackstone's alpha and Bank of America's alpha. Remember, alpha is how much better does this company perform when the rest of the market is performing well. Okay, and you can see Blackstone, Bank of America are really close together. And then we have our up move. And you see that Blackstone actually beats out Bank of America when it comes to up move. And I'll explain kind of what that means here in a moment. The down move looks like Bank of America is a little bit better, which makes sense because there's going to be more institutional investors in Bank of America than Blackstone. But what made my decision for me is, like I said, those numbers are based on the last 3 years, not current. Let me see if I can explain this. So this is based on July 20, no, I'm sorry. It's based on, make sure I get this right. It's based on July 2019, I'm sorry, July 2016 through July 2019. Okay, so this is not current data. This is just an average over the last 3 years. Okay, and I do this on purpose because I want to see kind of what's going on now, but I also want to know what has gone on over the last 3 years. And so the reason why I cut it off at July 2019 is because I don't want current data to mess with what has happened over the last 3 years, if that makes sense. Okay, so this is what happens over the last 3 years, but this is what's going on now. All right, and that's the big difference for me. What's going on now is that Blackstone has performed much better than Bank of America over the last 12 months. And you see that illustrated here. Bank of America is actually negative over the last 12 months, while Blackstone averages 2% a month. So I want to make sure you understand that. So this is averaging 2% return per month, okay, while Bank of America is averaging a negative per month, okay? And a lot of the reason why is because Blackstone has really just been in everyone's good graces recently. Like I said, it's the largest alternative asset investor. And what that means is that if you are a person that's wanting to invest your money, right, and you want to find a management company to do that for you, Bank of America is going to be your traditional bank, okay? Bank of America is going to invest in very simple, maybe treasuries, right? It's going to invest in maybe mortgages or something like that. Something very traditional, very simple, not going to get a super high return, but it's going to, give you a decent return, okay? Whereas Blackstone is going to invest in startups, okay? Blackstone is going to invest in, like I said, those shopping centers. Blackstone is going to invest in brand new companies that's coming into the market. And so you're going to get a much higher return, okay? And again, they're the biggest in the country right now. Everyone likes them, and that's the reason why they performed so much better. The other side of this is that we're already in Blackstone. Blackstone has already done well for us. The dividend is actually higher in Blackstone, and let's see if we can pull that up. I don't know if I'll be able to. Yeah, here we go. Yeah, so it got covered up. So anyway, but Blackstone's dividend is better than Bank of America too. So we're going with Blackstone. The other thing to talk about here is cash management, and I'll probably mention that over the course of these videos because it is, especially this year, it's such a big deal. The software always assumes that we're investing 100% of our money into the market, and so when you talk about cash management, the question becomes, well, do we leave any cash at all in the bank, or do we just send it all in? So it's going to be better for cash management if we stay in Blackstone. Another thing is that, and I don't have this pulled up, and I don't know if I'll be able to, honestly. I might get in trouble doing this because a lot of times this thing cannot handle opening two of these at the same time. Yeah, no, I can't show you. So anyway, once I entered all this stuff, the Blackstone position is is calling for almost 100 shares. Okay. Now, remember, we do what's called an iron condor, which means we purchase 100 shares of a company and we sell a call against it to sell it at a higher price, and then we sell a put against it to buy more at a lower price. And so what that means is we make money when we sell the call, we make money when we sell the put, and we're also making money from the dividend. And then we make money again when we actually do sell the stock. So instead of buying more shares of Blackstone, what we're going to do is we're just going to sell a put to buy more shares of Blackstone. So that'll put some extra money in our pocket. And I did that for just a month. So we're going to get the money now for the put. And then on January 19th, we'll either be able to purchase more shares of Blackstone at a cheaper price, or we'll just sell another put against that position, which means we can keep a little bit of cash in our pockets and still keep our position in Blackstone, still make the money on the dividend, and still possibly purchase more shares. Now, the question becomes, is it more profitable to keep selling puts or to actually purchase the shares? And for a company like Blackstone, which has done so well, I mean, we're up like 50% in our position. I think it's a better deal to just sell the puts because we can make so much money on them, almost $50 a month, which is $600 a year, which is not bad, and we keep our money in our pocket. So that's what we're doing there. HIG and DFS, they're good companies, but the earnings are not quite there for us. And again, we're already in Blackstone, so that's where we're going to stay.